keeping with that Fed speaking recession concerns, we're joined now by Skype by Alexander Causey from Russell Investments. Alex, good to have you back on the program. Yeah, the R word mentioned by the Fed chair last night, got a lot of press, as you would expect. What do you make about the risk at the moment? Because the Fed is going gung-ho trying to go and bring down inflation. At the same time, people are watching those leading economic indicators start to roll over.
Yeah, look, in the last couple of months, we have seen a rise in recession risk. So in-house, we had been at 15, 20% just a couple of months ago. We're more closer to about 30 to 35% recession risk in the next 12 months. And even within that, we were really worried about the second half of next year. We'd seen that first yield curve inversion leads by about 12 to 18 months. That kind of leads you to the second half. But I think with the way that the Fed are going right now, it actually is a risk that it comes a bit earlier than that. So yeah, we've become more concerned about those recession risks, certainly. And I think the next question that follows from it, and this is kind of where the market is moving now, is are we going to a really hard recession, or is it more of a technical, softer recession? Right now, given the strength of the corporate balance sheet, the corporate financing gap is still looking pretty healthy. Households look all right. We think it's more of a soft landing, or a soft recession, sorry, more of a technical recession. But that debate is still kind of playing out right now.
So recession, whether it's hard or soft, implies that we'll probably see a bit of weakness start to come through as well in inflationary pressures. Where does it leave fixed income markets at the moment? Because I'm looking across the fixed income universe, including sovereign yields here in Australia and other parts of the world, including the United States, and very juicy yields. I know in some cases, actual real yields based off where inflation expectations are. How do you see the fixed income universe at this point?
So we're actually starting to see quite a bit of value across the curve and across many countries. So the one that's probably the most bizarre is even in Germany, German bonds actually starting to look pretty healthy right now relative to where we think that the ECB will go. The most attractive parts of the government bond market that we think right now, and we're actively looking at trying to implement this in the next couple of days, is the Australian 3-year part of the curve and the US 5-year part of the curve. Because here in Australia, there just is a lot of action priced in from the RBA. A terminal rate near 4%. We think that's probably unlikely. And if you think about the three scenarios going ahead for the economy, for the global economy, you have the hard landing, so a recession. You have this perfect soft landing that the Fed engineer, so inflation comes down, and the third is stagflation. In two of those scenarios, we think the government bonds do really well. In the third scenario, stagflation, it's more challenging. But we do think that as you look further out, the risk of that stagflation is pretty low because it's pretty clear that central banks are going to do whatever they can to bring this inflation down.
So bond yields are close or have already gone and seen their highs for this cycle. What does it mean when it comes to equity market investments? Is it time to go and rejig that portfolio?
Look, this is a really challenging question right now because we have the fact that the discount rate is probably near the end in our opinion. And we also have a number of proprietary sentiment indicators that really try and gauge whether we're seeing signs of panic or we're seeing signs of euphoria. And they're really flashing green that we're seeing some signs of panic coming through the equity market. We're really waiting to see signs of that come through in the credit market. We're not really seeing that panic come through. But if we start to see that broad panic signal come through, along with that, we think that it's probably a healthy time to start adding a little bit of risk. I think the other thing to note is, you tend to see in a recession, 30 to 35% drawdowns in equity markets. We're about 22 to 24 in the US. So a lot of this is being priced in. So maybe we are set for a shorter term rally. And then the catalyst is a bit more challenging as you look further out. The longer term catalyst is a bit more challenging.
As you go down the capital stack, say in the credit markets and into equities, if you've got to be invested in those particular areas of the market, what would you want to be in at this point?
So we think emerging markets, actually, given that China is doing basically the reverse of everyone else and they're kind of easing policy, both on the monetary policy side and the fiscal side, there's a lot of risk priced into to both regulation of tech and how the Chinese economy is sitting. More broadly, we still think the valuation of non-US equities still looks pretty healthy. I guess you have to offset that, though, is that if we do see a rally in government bond rates, what that means for the tech sector in the US. So probably a bit more mixed on Europe versus the US, and EM still a bit of a preference.
Alex, fantastic to chat. Thanks so much for joining us here on Ausbiz. Enjoy the rest of the afternoon.
Thank you very much. Enjoy. Bye.